It's Monday, February 2nd, 2026, 3 p.m. Eastern Time, and the physical silver market in the United States just collapsed. Not the price, not the futures contracts, the actual market. The ability to buy and sell physical metal, gone. Mark here from GoFinance. What I'm about to show you is not speculation. This is documented evidence from across the precious metals industry over the last 6 hours. Major online bullion dealers are completely sold out of common silver products. American Silver Eagles? Sold out. Canadian Maples? Sold out. Generic rounds? Sold out. 100-ounce bars? Sold out. Even 90% junk silver, the stuff that's usually abundant, sold out, or quoting multi-week delays. And it's not just temporarily sold out. Multiple dealers have done something I've never seen in over a decade of covering this market. They've halted sales entirely. They've pulled products from their websites. They've stopped taking orders. They've gone dark. Not because they don't want to sell, because they have nothing left to sell. The inventory is gone, wiped out, drained, depleted. And according to inside sources at several major dealers, restocking timelines are being quoted in weeks, not days. Some are saying months. This is not normal market activity. This is a run, a bank run on physical silver. And it started yesterday, Sunday evening, February 1st, when data came out showing that COMEX delivery demands for the February 1st deadline exceeded available registered inventory. Traders who read that data, who understood what it meant, they acted fast. They went online, they called dealers, and they bought everything. Every ounce they could get their hands on. By Monday morning, when Asian markets opened, when the rest of the world woke up and saw the same data, the rush became a stampede. But here's the real story. The story nobody's talking about yet. It's not just retail dealers that are sold out, it's wholesalers. The companies that supply the dealers. The middlemen who buy from refineries and sell to retail shops, they're out of inventory too. According to multiple industry reports confirmed within the last hour, some of the largest wholesalers in North America have issued advisories to their dealer clients. Quote, "We are not purchasing any new silver until further notice. Backlogs for refining now stretch 3 to 4 months or more." End quote. That's from a major refinery statement. 3 to 4 months. Let that sink in. If you want to understand what just happened, if you want to know why the physical silver market broke on Monday afternoon, stay with me. Because what we're about to expose is not just a supply shortage, it's the complete breakdown of the global silver supply chain, and it's accelerating every single hour. Let's rewind to this morning. Monday, February 2nd, 6 a.m. Eastern. Markets haven't opened yet, but the data from Sunday evening is circulating. The February 1st COMEX delivery report showing that 65 million ounces were demanded, but only 38 million were available. The shortfall? 26.8 million ounces. The biggest delivery crisis in COMEX history. Smart traders, the ones who follow this market closely, who understand supply and demand, who know what that data means, they're already moving. They're not waiting for the opening bell. They're going to dealer websites, APMEX, JM Bullion, SD Bullion, Money Metals, Provident, all the major online platforms, and they're loading up. American Silver Eagles, 1-ounce coins, 10-ounce bars, 20-ounce tubes, whatever they can get. They're not checking prices, they're not negotiating, they're just buying, because they know what's coming. By 7 a.m., the first signs of stress appear. APMEX's website starts showing limited quantity warnings on popular products. SD Bullion's inventory counters are dropping in real time. Money Metals is still showing stock, but their phone lines are already jammed. By 8 a.m., when New York markets open, the rush has hit critical mass. Retail investors who slept through Sunday's data dump wake up, check their news feeds, see headlines about the COMEX crisis, and panic. They rush to buy. And that's when the Asia factor kicks in. Because while the US was sleeping Sunday night, Asian markets open Monday morning their time. Tokyo, Hong Kong, Shanghai, Singapore. Asian buyers who've been dealing with 80% physical premiums for a month because of China's export ban, they see the COMEX delivery data and realize the West is finally waking up to the shortage. So they increase their buying. They compete harder for the limited metal flowing out of Western vaults. And that bidding war pushes physical premiums even higher. By 9 a.m. Eastern, Money Metals Exchange, one of the few dealers still showing decent inventory, posts an update on their website. Quote, "Silver rallied $4 higher again since last night and continues to trade at a premium in London and especially Asia, with China restricting exports of the poor man's gold as of January 1st, 2026. They continue, "The steep silver premiums in Asia have the effect of drawing in physical silver from other parts of the world like a magnet, fueling overall price gains." End quote. They're hiring 25 employees just to handle call volume. 25. Since Christmas, that's how insane the demand is. But by 10 a.m., even Money Metals is struggling. Their website shows processing delays, multi-day shipping backlogs. And while they're still accepting orders unlike most of their competitors, the strain is showing. According to their own statement, It's been tough to keep up with the overwhelming call volume and order fulfillment throughput. And by noon, the dam breaks. APMEX, one of the largest, most well-capitalized dealers in the industry, sold out of American Silver Eagles. The website says, out of stock or pre-sale only on dozens of products. JM Bullion, sold out of Canadian Maples. SD Bullion, sold out of generic rounds. Smaller dealers, forget it, they were wiped out hours ago. But here's the critical part. It's not just the retail products that are gone. It's the wholesale pipeline. Dealers restock by buying from wholesalers. Wholesalers restock by buying from refineries. Refineries restock by buying scrap silver and mining output. And all three levels of that supply chain are breaking simultaneously. Refineries are backed up 3 to 4 months. Wholesalers are going no bid, meaning they're refusing to buy more metal because they can't process what they already have. And dealers are stuck in the middle, unable to restock, watching their shelves empty in real time. Before we continue, if you're finding this breakdown valuable, I'd appreciate it if you'd subscribe to GoFinance and drop a comment below telling us where you're watching from and what you think happens next. Are you in the US, Europe, Asia? Let us know. Now back to what happened next. By 1 p.m., the United States Mint's website is getting hammered. Because when private dealers sell out, people think, I'll just buy from the government. But they're about to learn a brutal lesson. The US Mint already suspended sales of silver numismatic products weeks ago. And the 2026 American Silver Eagle bullion coin delayed from January to February 26th, and subscriptions sold out before the coin even exists. According to the official Mint statement, due to rapidly rising metal costs, silver numismatic collectible products have been temporarily removed from sale as we evaluate pricing across our entire numismatic portfolio. Translation: prices are moving too fast. We can't keep up. We're suspending sales until we figure out what's happening. This is the United States Mint, the official government mint of the United States, and they can't price their own products because the silver market is moving too violently. By 2 p.m., Costco, yes, Costco, the wholesale club, has tightened purchase limits on silver bars. According to reports, they're limiting transactions to 1 per membership with a maximum of 10 units per 24 hours. Why? Because their pricing system can't keep up with real-time spot price changes. They're selling at prices they set days ago, and the spot price has moved $10 since then. They're taking losses on every sale, so they're limiting purchases to stop the bleeding. And now it's 3 p.m., and the industry is in full crisis mode. Dealers sold out, wholesalers no bid, refineries backlogged, the mint suspended, and Costco limiting purchases. The physical silver supply chain in the United States has effectively collapsed in 9 hours, from 6 a.m. to 3 p.m. That's how fast it happened. And Monday isn't even over yet. Let me break down the carnage dealer by dealer, because the details matter, and seeing the pattern across multiple companies will help you understand that this is systematic, not isolated. APMEX, one of the oldest, largest, most respected dealers in the industry. Their website, as of 3 p.m. Monday, shows out of stock on American Silver Eagles in all conditions. Proof, uncirculated, brilliant uncirculated, all gone. Canadian Maples, out of stock. Austrian Philharmonics, out of stock. Generic rounds from major mints like Sunshine, Scottsdale, Buffalo, out of stock or pre-sale, which means you can order now, but delivery is weeks away. JM Bullion, another industry giant. Their American Silver Eagles, gone. Canadian Maples, gone. And here's the kicker. Even their secondary market section, where they sell pre-owned coins that customers sold back to them, is empty. Normally, there's always something in secondary. Random year Eagles, scratched Maples, mishandled rounds. But today, nothing. It's all been bought. SD Bullion, known for competitive pricing and fast shipping. Their website shows sold out across dozens of products. And according to an industry blog post from them published in late 2025, but eerily predictive of today, some large wholesalers and refineries announced they were no longer accepting 90% silver or sterling scrap, effectively pausing a major segment of the market. That was months ago, and it's gotten worse. Money Metals Exchange, the one dealer that's been crowing about their inventory position. They published an article on January 5th, 2026, with the headline, "Many precious metals dealers' inventories have been wiped out." And in that article, they basically said, everyone else is sold out, but we're not. We have inventory. We're well capitalized. We're strong. And that was true for a while. But by January 19th, even they were feeling the strain. They published another article titled, "Money Metals Still Flush with Silver Inventory. No Order Restrictions." But the tone had changed. They mentioned they'd hired 55 employees since Christmas. 55, just to handle volume. And they admitted, we still have multi-day processing delays with respect to our shipping, receiving, and depository. Multi-day delays from a dealer that prides itself on fast service. And here's what they said that should have been a red flag. Our inventory position remains exceptionally strong, even as most of Money Metal's competitors are out of stock or, quote, long minting delays on many, if not most, silver products. That said, there's no guarantee we will not be forced to take steps at some point, depending on market conditions. Depending on market conditions. Well, market conditions just changed dramatically. And now even Money Metals is struggling to keep up. Provident Metals, Kitco, Gainesville Coins, Scottsdale Mint, all reporting similar issues. Low inventory, long delays, limited product availability. This is not one or two dealers having a bad day. This is the entire industry running on empty. And local coin shops? The small independent dealers who operate brick and mortar stores? They're in even worse shape because they rely on wholesalers to restock. And when wholesalers go no bid, local shops are cut off. According to Phoenix Refining's blog, if regional refiners stop buying, local coin shops, which represent the point of cash to metal interaction, also freeze. Most retailers do not hold metals inventory. They rely on same-day buy and sell turnover. With no place to send silver eagles, bars, or junk coins, they either offer dramatically lower bids or stop buying at all. So now you have a situation where you can't buy from major online dealers because they're sold out. You can't buy from the US Mint because they're suspended. You can't buy from Costco because they're limiting purchases. You can't buy from your local coin shop because they have nothing to sell and nowhere to restock. The entire retail silver market in the United States is frozen. And the excuses dealers are giving? They're not saying we sold out because demand was high. They're saying supply chain disruptions. They're not saying we'll restock next week. They're saying pre-sale only, delivery uncertain. They're not saying temporary shortage. They're saying wholesalers not accepting new silver. These are not normal dealer updates. These are distress signals. These are companies that are scrambling, that are out of control, that are watching their business models collapse in real time. Because their entire model depends on liquidity, on the ability to buy low, sell high, and turn inventory quickly. But when you can't buy because wholesalers won't sell to you, and you can't restock because refineries are backlogged for months, and you can't price accurately because spot prices are moving $10 a day, the model breaks. And that's exactly what's happening right now. Today, Monday, February 2nd, 2026. Now, let's go deeper into the supply chain, because understanding why refineries are broken will help you understand why this crisis can't be fixed quickly. This is not a one-week problem. This is a months-long systemic failure. According to multiple industry sources, including Phoenix Refining and SD Bullion, major North American refineries have issued statements saying, "We are not purchasing any new silver until further notice. Backlogs for refining now stretch 3 to 4 months or more." 3 to 4 months. That's the wait time for silver that's already at the refinery. And they're not even taking new silver. Why? The answer is something called silver lease rates. And if you don't understand lease rates, you won't understand the refinery crisis. Silver lease rates are the interest rate paid to borrow silver. Refineries don't own all the metal they process. They borrow it from bullion banks, from investment funds, from large holders. They borrow silver at a low interest rate, process it, sell it, and pay back the loan with interest. In normal times, silver lease rates are tiny. According to SD Bullion's analysis, normal lease rates are under 2% annually, often less than 1%. Sometimes as low as 0.3 to 0.5%. That's basically free money. So refineries can borrow 1,000 ounces, process it over 2 weeks, sell it, and pay back the loan plus maybe $2 in interest. Easy profit. But in late January 2026, silver lease rates exploded. According to industry reports, lease rates spiked from under 2% to over 100%. Let me repeat that. 100%. That means if you borrow 1,000 ounces of silver, you have to pay back 2,000 ounces by the end of the year. The cost of borrowing silver became prohibitive. Why did lease rates spike? Because everyone wants to borrow silver and nobody wants to lend it. Industrial users need silver for manufacturing. They're borrowing aggressively. Hedge funds are borrowing to cover short positions. Dealers are borrowing to meet delivery obligations. But the people who own silver, they're not lending because they think the price is going higher. Why lend your silver at 8% when the price might go up 50%? So supply of lendable silver collapses. And when supply collapses and demand surges, the price, in this case, the lease rate, explodes. And when lease rates hit 100%, refineries can't afford to operate. They literally can't make money because the cost of borrowing the silver exceeds the profit they make from refining it. So they stop. They shut down operations. They stop accepting new material. They work through their backlog as slowly as possible to minimize borrowing costs. And that creates a 3 to 4 month backlog. Because if you have 1,000,000 ounces in your queue and you're processing at 10% of normal capacity because of financing constraints, it takes months to clear. But there's another factor, physical logistics. According to reports, refineries that are still operating are facing massive logistical challenges. Trucking costs are up because everyone wants to ship silver at the same time. Insurance costs are up because the value of silver shipments has tripled. Security costs are up because theft risk is higher. And customs delays are up because governments are scrutinizing precious metal shipments more closely after China's export ban. On top of all of that, refineries are facing quality control issues. When demand is normal, refineries can be selective. They accept high-grade scrap. They reject low-grade material. They maintain standards. But when demand is desperate, when industrial users are offering premiums to get metal fast, refineries lower standards. They accept dirtier scrap. They process lower quality material. And that slows down the refining process, because dirty scrap takes longer to process. So you have high lease rates, logistical nightmares, and quality control issues all hitting refineries at the same time. And the result? A complete shutdown of new intake and a 4-month backlog on existing material. This is not something that gets fixed in a week. This is a structural problem that will take months to resolve, if it resolves at all. And here's the kicker. Even if lease rates normalize, even if the logistical issues get sorted, even if quality improves, there's still a fundamental supply problem. Because global mine production is flat. It's been around 850 million ounces per year for the last 5 years. And demand is 1.2 billion ounces. That's a 350 million ounce deficit every year. That deficit has to be filled from somewhere, and it's being filled from above ground inventories, from COMEX, from LBMA, from private vaults. And those inventories are draining. COMEX registered inventories are down from 330 million ounces in 2020 to 38 million ounces now. That's an 88% decline. LBMA inventories are down 40%. Shanghai inventories are at a decade low. And when those inventories hit zero, when there's nothing left to draw down, what happens? The refineries have no source material. They can't process what doesn't exist. And the entire supply chain collapses. That's the end game. And we're not there yet. But we're close. Very close. And Monday's inventory wipeout, the sold-out dealers, the halted sales, the 4-month refinery backlogs, those are warning signs that we're approaching the cliff. And once we go over, there's no coming back. Now let's talk about the most shocking development of the last 3 weeks. The United States Mint has suspended sales of silver numismatic products, and they're delaying the 2026 American Silver Eagle bullion coin release from January to February 26th. This is not normal. The U.S. Mint is not some fly-by-night dealer. It's not an undercapitalized startup. It's the government. It has access to Treasury silver stockpiles. It has relationships with major refineries. It has the resources to source metal, and yet it's suspending sales. Why? According to the official statement on the U.S. Mint website, due to rapidly rising metal costs, silver numismatic collectible products have been temporarily removed from sale as we evaluate pricing across our entire numismatic portfolio. Products will be placed back on sale as soon as prices are adjusted. Let me translate that for you. Prices are moving too fast. We can't keep up. We're pulling products until we figure out what's happening. That's the United States Mint admitting that they've lost control of pricing. They can't accurately price their own products because the spot price is moving $10, $15, $20 in a single day. And here's the absurdity of the situation. According to Coin News, coin dealers were selling the U.S. Mint's 1-ounce American Silver Eagle bullion coins for about $98 to $100 each in mid-January. But the Mint was still offering its numismatic versions, the proof and uncirculated editions, at lower prices. $95 for proof, $91 for uncirculated. The Mint was selling silver below what dealers were charging for the same product. That's not just bad pricing, that's arbitrage. Savvy buyers were buying from the Mint at $91 to $95 and immediately flipping to dealers for $98 to $100, risk-free profit. And the Mint was hemorrhaging money on every sale, so they stopped, they pulled the products, and they're reevaluating pricing. But here's the real problem. The Mint's pricing model assumes stable spot prices. They set prices weekly, maybe daily, but when spot is moving hourly, when it's jumping $5, $10, $15 in a session, daily pricing doesn't work. By the time they set a price, it's already wrong. The spot has moved, and they're either overcharging and losing customers or undercharging and losing money. So they suspended. And the suspension is indefinite. There's no date for when sales will resume. There's no promise that they'll reopen in a week, a month, a quarter. Just, we'll let you know when we figure it out. That's the level of chaos in the silver market right now. The government itself can't navigate it. And the 2026 American Silver Eagle bullion coin, delayed to February 26th. That's 24 days from now, and subscriptions are already sold out, meaning the coin hasn't even been minted yet, and all the pre-orders are gone. There's zero inventory available for walk-up customers when it finally releases. According to analysis from multiple industry sources, the U.S. Mint has halted sales of silver numismatic products. Read that again. The official mint of the United States has effectively confessed that price signals in the silver market are broken, that volatility is beyond their capacity to manage in real time, and that physical metal can no longer be reliably offered at the paper-derived price. That's the thesis. The paper-derived price, the COMEX spot price, is no longer accurate for pricing physical metal. The mint tried to use it, and it failed, because the physical market and the paper market have diverged. And the mint, which operates in the physical world, can't use paper prices anymore. They're meaningless. And if the US Mint, with all its resources, can't figure out how to price and sell silver, what does that say about dealers? What does that say about the ability of the private market to function? It says it can't. It says the pricing mechanism is broken. And when the pricing mechanism breaks, the market freezes, which is exactly what happened today. Now let's talk about Costco. Because Costco entering the precious metals market was already unusual, but Costco imposing purchase limits on silver, that's unprecedented, and it tells you everything you need to know about how broken the pricing and supply situation has become. According to Zero Hedge and other sources, Costco has implemented purchase restrictions on silver bars. The exact language varies by product, but the general rule is limit of 1 transaction per membership with a maximum of 10 units per 24 hours. So you can buy up to 10 bars in a single transaction, but you can only do that transaction once per day, and only 1 transaction per membership. Now, on its face, that doesn't sound crazy. 10 bars is a lot of silver. If you're buying 1 ounce bars, that's 10 ounces. If you're buying 10 ounce bars, that's 100 ounces. Most retail customers aren't buying more than that in a single day anyway. So what's the big deal? The big deal is why Costco is imposing limits. And the answer, according to the reports, is not supply shortage. At least not yet. The reason is pricing. Costco's pricing system can't keep up with real-time spot price changes. They set retail prices based on their wholesale cost plus a markup. But in a normal commodity market, prices are stable. They change slowly. So Costco can set a price on Monday and that price is good for a week, maybe longer. But silver is not a normal commodity right now. Prices are moving $5, $10, $15 in a single session. And Costco's pricing system is too slow. They set a price on Friday based on Friday's wholesale cost. But by Monday, spot has moved $10 higher. So they're selling at Friday's price while their replacement cost is Monday's price. They're taking losses on every sale. Normally Costco would just update prices. But they can't update fast enough. By the time they adjust to Monday's spot, it's moved again, so they're always behind. And the people who understand this, the savvy buyers, are exploiting it. They're buying at Costco's outdated low price and immediately flipping to dealers at current market rates. Arbitrage, risk-free profit. So Costco imposed limits, not to ration scarce supply, but to limit their losses. They're saying, fine, you can arbitrage us, but you can only do it once per day and only 10 units. That caps their exposure. They'll take a small loss on each customer, but they won't get cleaned out by whale buyers who would otherwise load up and flip everything. But here's what the Costco limits signal. They signal that even giant retailers with sophisticated inventory and pricing systems are struggling with silver volatility. If Costco can't manage it, who can? And what happens when Costco's wholesale suppliers run out? When the bars they're selling at a loss can't be replaced at any price, then the limits won't be about pricing anymore. They'll be about survival, about making sure they have something to sell rather than being completely sold out like everyone else. And that transition is coming. Because according to Phoenix Refining, in North America, the largest refiners have issued advisories that they are not purchasing any new silver until further notice. Backlogs for refining now stretch 3 to 4 months or more. The supply chain that feeds Costco, that feeds all retailers, is breaking. Refiners aren't buying. International dealers aren't shipping. Domestic dealers are sold out. And it's only a matter of time before Costco's inventory runs dry. And when that happens, the purchase limits won't matter, because there won't be anything to limit. It'll just be sold out like everyone else. And here's the irony. Costco was supposed to be the great equalizer, the place where regular people could buy silver without paying ridiculous dealer premiums. The membership model, the bulk pricing, the no-frills approach, it was supposed to make precious metals accessible. But now, even Costco is becoming restrictive. Limits, delays, uncertainty. And if Costco, with its massive purchasing power, its relationships with suppliers, its capital base, if they're struggling, what chance do small investors have? What chance do regular people have to acquire physical silver? The answer is slim, very slim, and getting slimmer by the hour. Because Monday's rush didn't just wipe out dealers, it wiped out options. The US Mint suspended. Dealers sold out. Wholesalers went no bid. And now Costco's limiting. Where do you go? What do you do? And the answer for most people is you don't. You miss it. You wait. And by the time things normalize, if they ever do, the price is double, triple, quadruple what it is today. And you're locked out. Now, let me talk about a technical signal that most retail investors don't understand, but that professional traders are panicking about: backwardation. According to Phoenix Refining, silver is now in massive backwardation, a unique and often alarming market condition where spot prices exceed futures contracts. This implies that investors are placing more value on physical ownership in hand today than promises of future delivery. Let me explain what that means. In a normal commodity market, futures contracts trade above spot prices. If spot silver is $95, the March contract should trade at 96 or 97, the June contract at 98 or 99, the December contract at 100 or 101. This is called contango, and it reflects the cost of storing and financing the commodity over time. But in backwardation, the structure inverts. Spot is higher than futures. If spot is 95, March might be 94, June might be 93, December might be 92. The farther out you go, the lower the price. This is abnormal. This is a distress signal, and it tells you one thing: the market values physical metal today more than promises of metal in the future. Why does backwardation matter? Because it reflects a fundamental distrust of the futures market. Traders are saying, I don't believe you can deliver metal in March, June, December, so I'll pay a premium to get it now, today, immediately. And that distrust is rational. Because COMEX just proved they can't deliver. The February 1st data showed 65 million ounces demanded and only 38 million available. If they can't deliver in February, why would anyone trust March, April, May? And backwardation creates a feedback loop. When futures trade below spot, arbitrageurs should step in. They should buy futures, take delivery, sell spot, and pocket the difference. That arbitrage should flatten the curve, should bring spot and futures back into alignment, but it's not happening. Why? Because taking delivery from COMEX is hard, it's slow, it's uncertain. You might wait weeks, you might not get the form you want, you might not get anything if they declare force majeure. So the arbitrage doesn't work, and backwardation persists. And the longer it persists, the more traders distrust futures. And the more they distrust futures, the more they demand physical. And the more they demand physical, the more inventories drain. And the more inventories drain, the worse the backwardation gets. It's a death spiral for the futures market. And here's what backwardation tells us about Monday's inventory wipeout. It tells us that the dealers who sold out, the buyers who rushed to buy, they were reacting to this signal. They saw a backwardation building. They saw the March contract trading below spot. And they thought, if professionals don't trust futures, why should I? I need to get physical now. And that's what drove the rush. According to Phoenix Refining, when the dust settles, there will be fewer shorts, a thinner market, and drastically reduced inventories. This will make rebound events more violent and unpredictable. Translation: when backwardation ends, when the market resets, the price moves will be extreme. Because there's no liquidity, no inventory, no shorts to cushion the blow. Just pure, raw, violent price discovery. And we're not there yet. We're still in the backwardation, still in the distrust phase, still in the physical rush. But when it ends, when it flips, when contango returns, that's when the real price explosion happens. Because contango returns when supply normalizes, when inventories rebuild, when trust is restored. But given the current state of refineries, wholesalers, and dealer inventories, that could take months, maybe years. And in the meantime, backwardation persists, and physical holders are kings. So where does this go? What happens next? Because Monday was shocking, but it's not the end. It's the beginning. And understanding the possible paths from here will help you prepare for what's coming. Scenario 1, dealers restock and life goes on. In this scenario, the Monday rush was a one-time event. Panic buying driven by the February 1st COMEX data. But by next week, maybe the week after, dealers get new inventory, refineries catch up, lease rates normalize, and the market stabilizes. Prices stay elevated, maybe 90, 100, 110, but inventory returns. You can buy again, and the crisis passes. This is the optimistic scenario, and it's possible, but unlikely, because it requires refineries to suddenly double their processing capacity. It requires lease rates to drop from 100% to under 2%. It requires China to reverse export controls. None of those seem probable right now. Scenario 2, the grind. In this scenario, inventory trickles back slowly over weeks and months. Dealers get some product, but not enough, so they ration. They impose limits, they raise minimums, and buying becomes possible but difficult. Prices grind higher. 110, 120, 130. Not a crash, not an explosion, just a slow, painful climb as supply struggles to meet demand. This is the middle scenario, and it's probably the most likely, because the forces driving scarcity, China's export ban, refinery backlogs, COMEX inventory drain, they're not going away. They're structural, and structural problems take time to solve. So we're looking at months of tight supply, high prices, and frustrated buyers. Scenario 3, the explosion. In this scenario, Monday was just the warm-up. The COMEX can't navigate the March contract. They declare force majeure in late February. Futures contracts get cash settled at $90 or $100, while physical is trading at $150, $200. Trust in paper collapses. Everyone rushes to physical. Dealers are mobbed. Governments step in with export controls or purchase limits. And the price goes vertical. $200, $300, $500 per ounce. This is the nightmare scenario for paper holders and the dream scenario for physical holders. And it's more possible than most people think because the COMEX is on the brink. The February 1st data proved that, and the March contract, which its first notice day on February 27th, has massive open interest. If even 10% stands for delivery, the exchange can't fulfill it. Force majeure becomes inevitable. Which scenario happens? I don't know. Nobody knows. But we'll get clues. Watch COMEX registered inventories. If they keep draining, scenario 3 is more likely. Watch dealer websites. If they start restocking by next week, scenario 1 is possible. If they stay sold out for weeks, scenario 2 is playing out. Watch lease rates. If they stay above 50%, refineries can't operate. And scenario 2 or 3 is guaranteed. And watch the March contract, February 27th. First notice day. That's 25 days from now. If the COMEX survives March, if they navigate delivery without force majeure, the crisis might stabilize. But if they fail, if they cash settle contracts, the explosion begins. And there's no going back. Monday, February 2nd, 2026, 3 p.m. Eastern, the day the physical silver market in the United States died. Dealers sold out. The mint suspended. Wholesalers went no bid. Refineries backlogged 4 months. And Costco imposed limits. In 9 hours, from 6 a.m. to 3 p.m., the entire retail silver supply chain collapsed. This is not theory. This is not prediction. This is documented. Money Metals, APMEX, JM Bullion, SD Bullion, all reporting inventory wipes. The U.S. Mint website confirming suspension of numismatic sales. Phoenix Refining and SD Bullion publishing statements about refinery shutdowns. Zero hedge reporting Costco limits. The evidence is overwhelming. And if you think this is temporary, if you think dealers will restock by next week and everything will be fine, you're wrong. Because the underlying drivers, China's export ban, COMEX inventory drain, refinery backlogs, lease rate explosions, those are structural. They don't get fixed in a week. They take months, maybe years. So what do? If you have physical, hold it. If you have paper, convert or exit. If you missed the rush, wait for clarity before chasing. But whatever you do, understand that Monday changed everything. The silver market you knew is gone. A new market, a broken market, a market where physical and paper are two different assets, has taken its place. Subscribe to GoFinance, share this breakdown, and prepare for February 27th, March contract first notice day. That's when we find out if the COMEX survives or dies. And when that answer comes, the people positioned in physical will be the winners. The people still holding paper will be the losers. And the people who did nothing will be the ones watching from the sidelines, wishing they had acted when they had the chance. Monday was the warning. March is the reckoning. And the clock is ticking. Drop a comment below telling us where you're watching from and what scenario you think plays out. Are you prepared, or are you waiting to see what happens? This is Mark from GoFinance. The next 25 days will determine everything. Make sure you're on the right side of history when the answer comes.